Okay, you guys, we're now going to look at exercise 3-9 on page 148. I think you'll find this one's a little more challenging than what we did before. I hope you like it. I know this is the kind of problem I really enjoy. Okay, they tell us the following is a balance sheet of Corver Supply Company at December 31, 2015. And they give us their balance sheet there. Fairly simple one. Under assets, we have cash, accounts receivable, inventories, furniture and fixtures, net of accumulated depreciation. Then they get a total assets number there. Accounts payable, which is only used, they say, to purchase merchandise or inventory. A note payable and some interest payable. We got additional information about that below number 7. Common stock and retained earnings. Okay, so they give us the 2015 balance sheet. They want us to prepare the 2016 balance sheet given last year's balance sheet and this additional information, 1 through 7, and then those, 3 sentences below that. They said prepare a classified balance sheet at December 31, 2016, ignoring income taxes. All right, so the heading doesn't change, you guys. Nothing different there. Corver Supply Company, balance sheet at December 31, 2016. Okay, and then our first section, of course, would be assets. And under assets, we'd list current assets first. Now we're going to get to some calculations. We need to know the cash balance. So given the cash balance last year and this additional information, we can figure out the cash balance at December 31, 2016. Let's go to an Excel spreadsheet to look at that. Okay, so we'll start with the cash balance at 12/31/15, which was $120,000 there from the balance sheet. All right, then we want to add any cash coming in and deduct any cash going out. So number 2 says cash collected from customers. We're going to say plus cash collected from customers. Sorry, the plus messed me up. Cash collected from customers. Alright, we'll just enter the positives as a positive number, negatives as a negative number. Cash collected from customers, of course, would increase the cash balance at $780,000. Okay, then we have the next one that affects cash payment to suppliers. Now that one's going to be cash going out, so we'll enter this one as a negative amount, $560,000. Then we've got cash paid for operating expenses. Cash going out as well, $160,000. Then we've got cash paid for interest on note. Cash going out as well, negative $12,000. All right, now if we total that up, that should give us cash balance at 12/31/16. All right, so let's sum that one. That gives us $168,000. All right, so let's go back to the balance sheet and put in cash. And there you go, it's $168,000, our first current asset. Okay, now we'll make some similar calculations for each account. Let's go next to accounts receivable. Okay, the beginning balance, or the balance at the end of 2015 for accounts receivable, $300,000. Okay, what's going to increase accounts receivable? Well, sales to customers on account would increase accounts receivable. Okay, so that's going to be a positive number, 800,000. Okay, cash collected from customers. This is assuming, you guys, that all their sales were made on account. They don't tell you that, but you can assume it. Cash collected from customers then would all decrease accounts receivable. That's negative 780,000. All right, and then if we total that up, that'll give us our accounts receivable balance on 12/31/16. $320,000. So let's go back and put that in on the balance sheet. So there you go, 320,000. You guys, we could do these with T accounts. You might find that to be easier. You're really kind of just going through journal entries. So you could take number 1, sales to customers on account. Well, that's going to be a debit to accounts receivable and a credit to sales. So if you're more comfortable with the T accounts, that works too. Whatever you prefer. Alright, so next let's go to inventories. Okay, so our beginning balance in the inventories account's $200,000. That's from the balance sheet at the end of December 2015. Okay, we're going to add to that. What would increase inventory? Well, purchase of merchandise on account. That's inventory. Let's just call that purchases. That's 550,000. Well, when inventory is sold, it's decreased, and cost of merchandise sold is increased. So the cost of merchandise sold, every time it's debited, we're decreasing inventory. So our cost of merchandise sold would decrease inventory. It was 500,000. Okay, and then this should give us inventories at 12/31/16 when we total it up. You guys, this is the kind of thing you can find yourself doing. You get out to a business and they've got last year's balance sheet that you help them prepare, but they really maybe just have it and some additional information for the new year. For some of that you might even have to put together. So I think this one's really good practice. Let's go on and put that inventories number on the balance sheet. Before we do that, I hope you noticed the problem. Purchases would increase inventory. Cost of merchandise sold, though, would decrease inventory. Pretty big difference there. 1.25 million or 250,000. Excuse me on that one. This one should have been entered as a negative. So our inventories balance will be 250,000. And that's it for current assets. So let's total those up. We get total current assets of 738,000. Alright, then we want property, plant, and equipment. Let's read about that in the sentences below number 7. Third sentence, they say depreciation on the furniture and fixtures for the year is 20,000. Furniture and the fixtures originally cost 300,000. Well, that's all we really need right there. So we'll say property, plant, and equipment. Okay, so we'll list furniture and fixtures at their cost, $300,000. And let's see if we can figure out the accumulated depreciation. Well, depreciation for 2016 is $20,000. Let's look at furniture and fixtures at the net amount was $150,000 last year. We know the cost though hasn't changed. Cost was $300,000. So let's go over here. Cost of furniture and fixtures is $300,000. Book value, which is cost minus accumulated depreciation, they're calling it net. I should do that too, I guess. Net value on 12-31-15 was $150,000. So let's subtract that out. Okay, and then that difference is going to be accumulated depreciation 12-31-15. Okay, so our accumulated depreciation at the end of last year was $150,000. Depreciation for this year is $20,000. So accumulated depreciation at the end of 2016 will be $170,000. So what we'll do here, we've got accumulated depreciation at the end of 2015. Just the cost that we were given less last year's net value or book value. That gives us the amount of accumulated depreciation at the end of 2015. Plus we'll add the depreciation expense for 2016. And then that's going to get us to our accumulated depreciation balance at the end of 2016. It's going to be equal to the 150 plus the 20,000 depreciation for this year. That's 170,000. Let's format that like this. There we go. That one took a little bit extra, but we got there. Okay, so I hope that makes sense. Let's go back through it. They give you the cost of the furniture and fixtures, $300,000, and that's static. They didn't tell us that any more were purchased. We know the net value of the equipment on last year's balance sheet was $150,000. Well, if we take the difference in those two, that gives us the accumulated depreciation at the end of 2015. Add depreciation expense for 2016, and we get to accumulated depreciation at the end of 2016. Now let's see what that looks like on the balance sheet. We got our furniture and fixtures at $300,000, less accumulated depreciation of $170,000. That gives us net property, plant, and equipment of $130,000. We'll add that to total current assets, and we get total assets of $868,000. All right, now let's take care of the liabilities and shareholders' equity section. Well, I always want to say stockholders' equity. Those words are interchangeable, you guys. I really love this kind of problem. I hope you guys do too. I think they're a lot of fun. Okay, let's move on to liabilities and shareholders' equity. First thing we'll list there will be current liabilities. And the first one of those we'll list, as you probably saw there, is accounts payable. Alright, so let's figure out its balance. Okay, we'll start with the accounts payable balance at the end of 2015, $190,000. We're going to add to that purchases made on account, $550,000. That would have increased accounts payable. Less cash payment to suppliers of $560,000. Well, we're paying them for what we owe them on account. So that's going to decrease accounts payable of $560,000, and that gets us accounts payable at 12/31/16, $180,000. All right, next we want to determine the amount of interest payable. Okay, let's read about that note. It's dated June 30th, 2015, and it's due on June 30th, 2017. Interest is payable at 6% annually on June 30th. Okay, well, we haven't made any principal payments on the note. So there's really no calculations to do here, you guys. We owed the note balance at the end of 2015, and at that point we would owe interest for what, a full year? But the interest expense that built up during December 31, 2015 to June 30th, 2016, that's already been paid. We just want to calculate how much interest do we owe from July 1st to the end of the year. Well, you can run through the calculations. The balance on the note is $200,000. Okay, let's do that over here. Interest on note payable is equal to our $200,000. We're only calculating 6 months worth, so I'm going to do 6 divided by 12 is how this book does it, times the 6%. See, the only interest that's been built up and not already recorded as an expense this year built up between July 1st and December 31st, so 6 months worth. So that comes to our $6,000. I like for it to have the dollar sign. So that didn't change. Okay, it's different. It's interest now from July 1st, 2016 to July 1st, or to December 31st, 2016, that last 6 months of 2016. The one shown on last year's balance sheet was for the last 6 months of 2015. It just happens to be the same amount because no principal payments have been made in the meantime. Alright, so we've got interest payable, $6,000. We still have the note payable of $200,000. Like I said, no principal payments have been made. It's due on June 30th, 2017, so that's less than a year from our balance sheet date, so it is considered a current liability. So we get total current liabilities of $386,000. Then we'll look at shareholders' equity. Well, common stock hasn't changed. They didn't issue any new shares that we've been made aware of. The balance last year was $100,000. The balance this year is going to be $100,000. The only thing we've got to calculate still is retained earnings. Okay, so we'll start with our retained earnings balance from the 2015 balance sheet. That's $274,000. All right, now what increases retained earnings, what decreases? Well, remember, net income increases retained earnings. We don't know how much net income was. We do know how much our sales and expenses were. Remember, sales increases net income. would include sales here. Again, assume all theirs were made on account. Alright, we've got cost of goods sold. Or I think they said cost of merchandise sold is an expense. That one's going to be $500,000. Right, then we've got operating expenses. You're having to assume they were paid in the period incurred here. They don't really mention that, but we'll make that assumption. Okay. We also have depreciation expense for the year of 20. Remember, it was 20,000 from that additional information. And then our interest expense for the year, well, we calculated already that it's 6,000 for that final 6 months of the year. Well, the expense then for the entire year would be 12,000. You could calculate it like this. We're going to show it as a negative number, so 200,000 just times the 0.06 because this is for a year. That's $12,000. So let's sum this and we'll get our ending retained earnings balance. 382,000. Let's make sure that's right when we come over here. There we go, 382,000. Now, we'll add together common stock and retained earnings to get total shareholders' equity of 482,000, which will add to total current liabilities, and that gets us total liabilities and shareholders' equity of 868,000, same as total assets. Hope you enjoyed that one, you guys, and good luck on the one on the course McGraw-Hill site. Please let me know if you have questions. Thanks.